In this video, we demonstrate how Hildene applies its investment paradigm to CLOs. We can begin to understand the components of value in a CLO. Here, we have a loan collateral pool worth $100 million, with $90 million of it sliced up as debt tranches and the remaining $10 million as the equity. This is the value of the PO, where PO stands for principal only. The underlying pool of loans pays interest in the form of a floating rate coupon that is passed through the deal's waterfall to make payments to the various CLO tranches. This graphic illustrates the value of this IO, or interest-only portion of the cash flows. The underlying loans in the collateral pool pay a weighted average coupon of 3.8%, which is pooled and distributed to various tranches at their preset coupon rates. For simplicity, we will use the blended average rate of 2.6% that ends up getting paid to debt investors on a combined basis. The 1.2% coupon leftover, referred to as the excess spread, is paid to the equity. Since the equity is only 10% of the balance, receiving 1.2% of the interest on the entire collateral pool is effectively a 12% interest return on equity. Remember how different tranches have different risk-reward profiles? A key factor in determining this calculus is over-collateralization, or OC tests. These tests are a key component of the rules in place to protect senior tranches of a CLO from taking avoidable losses. Effectively, for the CLO to function normally, each tranche needs to maintain a specified level of over-collateralization. Let's take the E tranche, for example. The collateral backing the CLO must be 106% or higher than the balance of the tranches at the same or higher level of seniority to the E tranche, meaning tranches A through E. In our example, the OC value at tranche E is 111%. Since it's higher than the test value of 106%, the equity tranche below it gets paid the excess cash flow. However, if this value drops below 106%, the CLO starts trapping cash instead of leaking it to the equity. These trapped cash flows are used to pay down the senior-most debt, thereby reducing the total balance of debt and de-risking the structure. As the balance of the senior notes goes down, the OC value starts to rise. Once it rises above the test value, business can resume as normal and equity payments restart. To value a CLO tranche, it is very important to understand the value of the CLO structure. The last piece of the CLO valuation puzzle is the value of the collateral manager. Different managers have different levels of the experience and skill required to navigate the leveraged loan landscape. In a later video, we will illustrate our manager ranking methodology in more detail. Here, we show you how a good manager can add value by making good loan trading decisions, while a bad manager can generate trading losses, hurting the overall CLO and especially the junior-most tranches, given they are first in line to incur losses. CLOs are complex structured credit instruments with a lot of moving parts. At Hildene, we believe that some market-accepted metrics for valuing CLOs are flawed, which has prompted Hildene to create its own proprietary metrics and algorithms to value CLO tranches. An example is Hildene's ENAV metric. CLO market participants rely on market value, or MVNAV, to measure a tranche's intrinsic value and to tier tranches across deals. MVNAV values CLO tranches based on current prevailing loan prices. Loan prices, however, change daily based on the macro environment and loan trading technicals, along with changing risk and liquidity premia. Unless the CLO is being liquidated in the very near future, MVNAV can substantially overestimate or underestimate the final collateral value that the CLO will realize. Hildene uses its expected NAV or ENAV metric to estimate the final collateral value, which Hildene believes to be more accurate than MVNAV. ENAV is derived through a combination of quantitative analysis of the loan pool and fundamental analysis of distressed assets within the CLO's portfolio. At Hildene, we consider various nuances of a CLO when making our investment decision. A key aspect when investing in the CLO's equity tranche is ensuring proper alignment of interest between the equity investor and the CLO's collateral manager. For instance, in certain deals, the interest diversion or ID test value is calculated after paying the manager their subordinate asset management fees. In these deals, even if the ID test fails, the manager gets paid their management fee while cash flows to the equity get impaired. Hildene seeks to invest in deals where the ID test is calculated before paying the sub-management fees so that the manager's incentives are better aligned with the CLO equity investors. Hildene's investments in CLOs are concentrated in the lower parts of the capital structure. Our years of experience investing in structured credit products, along with our proprietary data analysis infrastructure, helps us navigate the CLO investment landscape. At its heart is choosing the right deal and the right collateral manager. An equity investment in a deal with bad collateral and a bad manager can quickly see an erosion in value, shutting off of cash flows, and negative realized returns. An equity investment in a deal with good collateral and a good manager can see the opposite, where the value of the IO and the value of the PO go up over time as the manager navigates deftly through the business cycle, making good credit and trading decisions. This holistic approach to deal and manager selection is central to our investment thesis.